So the most basic question to ask about the Federal Reserve is, why do we have it? Why do we have a central bank? And I don't know if you remember this episode, but this came up in 2007 when Alan Greenspan, who had just left the job of chairman of the Fed, was promoting his first book. I believe the title was "It Wasn't My Fault." Or was that his second book? I can't remember. And somebody wrote a very good question for Jon Stewart, which was, you believe in free market economics, so why do we have a Fed, right, setting interest rates? Why doesn't the free market take care of all that? And Greenspan was kind of stunned. That's a very good question, he said. A very fundamental question. And when he finally came up with an answer, he said, well, we didn't need a central bank back when we were on the gold standard. And this is a little muddled, but you can get his drift. All the automatic things occurred because people would buy and sell gold, and the market would do what the Fed does now. And then he went on to say, but now we no longer are on the gold standard, so somebody has to control the quantity of money, and that's the Fed's job. But if you reflect on what he's saying, look, in 1913, when the Federal Reserve Act was passed, the United States was on the gold standard, so the Fed wasn't needed. At least it wasn't needed for monetary policy. And in fact, the Fed was not created to run monetary policy. The Fed is our central bank. What does it mean to be a central bank? Well, I used to think, when I first decided I had to give a lecture on this topic, that there must be one defining characteristic of a central bank, like there's one defining characteristic of a bird. As you know, if you've read What is a Bird by Robert Sneeden to your children over and over and over again. Anybody know what defines a bird? One thing, if you have it, if a creature has it, it's a bird.
Wings.
Not wings. Bats have wings. Not a beak. Feathers. If it has feathers, it's a bird. No feathers, no bird. Well, there isn't anything like that for a central bank. The best we can do is give a list of characteristic roles. And so there's debate historically over some institutions, were they a central bank? Because they only did one or two of these roles, like the first and second banks of the United States. But these characteristic roles are serving as a banker's bank, that is running the check clearing system. The Fed does that. The sole issue of currency notes. The Fed does that now, but it didn't at the beginning. Regulating commercial banks. Fed does that. Lender of last resort. That one's a little different. That's more of a prescription than a description. Something a central bank is charged with doing, but may or may not do effectively. And last, monetary policy. But the Federal Reserve Act was about 1, 3, and 4. It was not about 2 or 5. And yet today, we associate the Fed with monetary policy and to some extent with bank regulation. What was the driver behind the Federal Reserve Act? Well, it was the Panic of 1907. And the Panic of 1907 was the last of a series of panics. Some say there were 3 panics. Some say there were 5 if you count 84 and 90. 84 and 90, there were not widespread suspensions of bank payments or runs on banks, but in the other 3 there were. And they were characterized by peaks in interest rates. Everybody was scrambling for liquidity. And so nobody wanted to lend money, and lots of people wanted to borrow money, so interest rates went shooting up. If you only knew U.S. banking history, you might think, well, this is an inherent problem with the banking system. But if you look around, say if you look north of the border to Canada, which is at that time a lot like the U.S. economy, very agricultural, spread from the Atlantic to the Pacific, you don't see any of these problems. And you don't see them because Canada has a different banking system. They have a system where banks are allowed to branch from coast to coast, unlike U.S. banks. And there aren't restrictions on banks' ability to meet the public's demand for currency in seasons where there's a peak demand for currency. Nowadays, the peak demand for currency is around Christmas. In those days, it was what they called crop moving season, in the fall and in the spring when the farmhands got paid. And they got paid wads of banknotes if the farmers could get them. I'll come back to that in a second. But no such problems in Canada. So it wasn't inherent to the banking system. It was due to the way we had regulated the banking system. And those regulations came out of the Civil War. They were passed not to create havoc in the banking industry, but to force the banks to buy union government debt. It was a fiscal measure, ultimately. So one way to fix the problem would have been to move toward a Canadian-style system. Make the banks stronger by allowing them to branch more widely, which would allow them to diversify better. The American Bankers Association actually proposed this. Nowadays, the American Bankers Association has learned to live with our bank regulatory system and will not propose deregulation in any serious way. But that was their proposal in 1894, and there were other such plans. But the small bankers killed it. So the two key planks of the plan were end the restrictions on banks issuing their own currency, their own banknotes. There was a limit to how much they were allowed to issue because they were only allowed to issue notes to the extent of the federal bonds they held. That was the fiscal part of it. If banks wanted to issue notes, they had to buy federal bonds, so that created a captive market for federal bonds. But it also restricted the amount of currency banks could issue because, and this will shock you, after the Civil War, we actually started to pay down the national debt. That used to be the sort of way things went. You ran up the debt during the war, but then you paid it down. So less collateral for backing notes, fewer notes could be issued. There's a shortage or a scarcity of currency. Second problem was the branch banking problem. But when you tied branch banking into the reform, then the small banks were not going to have it because they didn't want large banks branching into their neighborhood. So we got the Federal Reserve Act, and I've cleaned up the text here, but you'll have to trust me that this is the actual text, the preamble, to provide for the establishment of Federal Reserve Acts. Federal Reserve Banks. The main feature of the Federal Reserve System, as it was originally conceived, were the 12 regional reserve banks. And the Board of Governors in D.C. was just kind of a coordinating committee. It wasn't supposed to be the center of power. To furnish an elastic currency, well, so that means during crop moving season, provide more currency so that the farmhands can get paid without there being a scramble. Because if the banks couldn't issue more currency, the farmers would say, okay, I'll take silver coins. But silver coins are reserves to the banks, so the banks are losing reserves, and then they're scrambling, and they're pulling money out of New York, and now New York's got a problem. So if somebody could provide more currency legally, some bank clearinghouses were doing it illegally, that would help. To afford means of rediscounting commercial paper, that's a way of giving banks more reserves in times where reserves are draining out of the banks. So that's the lender of last resort role. To establish a more effective supervision of banking, so that's the bank regulation role. All right, but there's nothing in here about monetary policy because the gold standard was expected to control the quantity of money. So you can think of the original Federal Reserve System as 12 regional reserve banks, and it was supposed to be decentralized because outside of the eastern seaboard, people didn't want Wall Street to control it, and they didn't want Washington, D.C. to control it. So it was supposed to be a decentralized system. Bankers would go to their regional reserve bank, and the 12 regional reserve banks had different policies. They didn't all have the same interest rates back in those days. But they served as bankers' banks. They were lenders of last resort to the banks in their region. All right, so it wasn't a national policy. And they supervised their member banks. But not monetary policy. The picture here shows a Federal Reserve Bank of Richmond note from 1929 and an ordinary commercial bank note, the Providence National Bank from Providence, Rhode Island. They're exactly the same, except for the name on the left. So the Federal Reserve was just one of many issuers of currency. How could you let commercial banks issue currency? Well, look, there's a limit because it's redeemable. If you read the text, it says, will pay the bearer on demand $20, which means they had to produce a $20 gold coin if you came in and demanded redemption. And the most important check was, or limit on the banks, was at the clearinghouse where banks are exchanging checks and currency, a bank had to settle up the difference with other banks by producing gold or silver. So they could only they could only issue as much currency as they could afford to redeem. So that was how the gold standard limited the quantity of money. But as the picture shows, the Fed didn't monopolize the issue of currency, and it didn't control the overall quantity of money. The gold standard did that.